This will be an action-packed reporting season.
I think we're going to see a turbulent ride followed by very opaque outlook statements.
The main theme will be rising cost pressures on businesses.
The outlook is looking cloudy.
I think it'll be a reporting season that really draws a line in the sand.
This year's reporting season is shaping up to be one of corporate Australia's most interesting yet. On the one hand, high energy and commodity prices will deliver good results for some. But on the other, soaring cost pressures and recession fears are starting to bite. So how do our experts think Australian businesses have performed, and what does the future hold?
There are companies that are having to deal with a range of issues on both the supply and demand front.
And COVID and closed borders have seen employers struggling to find enough workers.
Businesses are increasingly finding it hard to get the staff they want, and the costs of getting that staff is very expensive.
And inflation has hit hip pockets and consumer confidence.
I think there's some question marks about the sustainability of consumer demand, just given everything we know that's going on with rises in interest rates and what's happened to real incomes growth in the household sector.
Soaring gas and power prices have impacted just about every business to the downside, except of course the producers of that energy, like Woodside and Santos. So those businesses and commodity giants like BHP and Rio Tinto, who've also cashed in on higher prices, are forecast to deliver good numbers.
The miners and energy stocks, their earnings over the last 12 months are up 100 or 200%, and that is really what has driven the strong profit growth across corporate Australia.
I think the Aussie banks continue to do okay. They always are okay in the early part of a rate hiking cycle.
And that cycle is well underway, with the banks eyeing a fourth hike from the RBA on Tuesday. And the lower Australian dollar also benefits exporters.
That's going to boost offshore earnings by a lot of companies. So a weak Aussie dollar is a positive for corporate earnings.
But for consumer businesses like retail and leisure, since the heady days of the pandemic lockdowns, results will be bleaker.
Those companies that have over-earned during the COVID period, which may see their revenue and earnings, and on top of that, their higher than expected margins that they've been able to generate over this period mean reverting reasonably quickly.
I think the obvious losers this time around are going to be consumer-facing ones, and not necessarily through their own doing, just because of the environment that they sit in.
While the airports are crowded, it's not translating into bumper bottom lines for travel stocks. This reporting season is seen very much as a turning point. Analysts say forward guidance from companies will be more important than ever.
I think the focus will really be on what the outlook is going forward, because as we know, it's a far more uncertain environment, and the market has started to really focus in on the prospect of a global recession.
To head off rising costs and recession risks, companies are likely to keep cash in the kitty, and that means less for investors.
Probably does make sense to be more conservative than not when it comes to dividend payouts.
Just like households, businesses will be reining in their spending for an uncertain year ahead.